The Federal Reserve has raised interest rates again to almost 4%, and stocks have all taken a big hit. However, stocks may still go down given the fears of an impending recession. In this video, I'm going to share with you how you can short the market using 3 simple steps, and of course, the risks involved in them as well. With that, let's dive in. But before we begin, I would appreciate it if you can help to tap the like button and subscribe to my channel, as I'll be coming out with more of such videos. In return, I will show you a financial meme. Central banks across the world are increasing interest rates to combat sky-high inflation. And inflation is likely to stick around longer due to the clog-up supply chains from the COVID lockdowns as well as the invasion of Ukraine. Hence, the global economy is at risk of a recession. Even the famous Warren Buffett indicator is showing that the market is 22% higher than the long-term market average, which essentially means that the market has more room to fall. With all this negativity going on, many investors are looking for ways to short the market. But the concept of shorting is where you aim to profit from a decline in an asset's price. This means that instead of the usual buy low, sell high, you're doing exactly the opposite, which is sell high, buy back low. So how do you actually do it, and what are the risks involved? In this video, I'll be sharing with you 3 ways on how you can do short selling and also highlight the risks involved for each method. The first one is the usual straightforward method where you borrow shares from a broker and then sell it at the current market price. Subsequently, you buy it back in the future with the hope that the share price will go down. For example, if you think that Facebook or Meta platforms is likely to go down lower from 90 US dollars to maybe 60 US dollars, you can borrow 100 shares from the company, from the broker, sell it in the market for $90. And if your prediction is right, you can then buy back the shares when it hit 60 US dollars. So net, you return the 100 shares back to your broker and you make a profit of 90 minus 60 times 100 shares, which is equals to $3,000. Alright, while this sounds exciting, right? Wow, so easy, right? But the big drawback of this method is that there is potential of unlimited losses. So imagine instead of going down to $60, what if Meta went up to 200 US dollars instead? You would have lost 110 US dollars per share, or a total of 11,000 for 100 shares itself. So the other way, the second method to short the market is to buy a put option. Using back the same scenario, you can buy a put option for around $2 premium that expires maybe in March 2023 for a strike price of 60 US dollars. Okay, a put option gives you the right to profit when the share price actually goes below the break-even point. So for this, there are many things you need to take note when trading options, and it is a whole course by itself. But I just need to highlight some key points for your reference, right? So the first one is that there's this upfront premium, which is the maximum amount that you will lose on this trade if you don't exercise your options. So because the option offers you the right, not the obligation, to profit when the share price drops below the break-even point. The second thing to note is that many options expire worthless because oftentimes the share price doesn't reach where you want it to go by the option's expiration date. So that means, like, let's say you buy a put option, you think that it will go down below $60 by next year March, but maybe it only goes down to 70 US dollar and you are not in the money. That means you are not making profits. So in that sense, it will expire worthless and your $2 upfront premium will be gone already. All right. Okay, so the third and final method that I'll be sharing is this buying of the inverse ETF. So an inverse ETF is actually an exchange traded fund, or ETF, that's constructed to profit from a decline in the value of an underlying benchmark. Okay, so simply put, inverse ETFs allows investors to make money when the market or the underlying index falls, and you don't have to sell anything short or buy put options or anything. You can simply just buy the inverse ETF, and if the market goes down, the inverse ETF share price will go up. Okay, so for example, an example is the ProShares short S&P 500. Symbol ticker is SH. All right, it is an inverse ETF that seeks to provide the daily investment results corresponding to the inverse or negative 1 times of that of the daily performance of the S&P 500 index. What this means is that if the S&P 500 index go up by 1%, the inverse ETF will drop by 1%. Right? You can even take it up one notch by going for the ProShares Ultra Pro Short QQQ, or symbol ticker SQQQ. All right, this offers a 3 times leverage daily downside exposure to the tech heavy Nasdaq 100 index. All right, so this is a 3 times leverage. Means if the Nasdaq 100 index go down by 1%, you will make a 3% gain. Okay, this ETF is designed for traders with a bearish short-term view on the large cap technology names. Next up, let's talk about the risk involved with short selling. Okay, the risks involved. So one of the biggest risks of shorting is that time is not on your side. All right, history has proven that markets always go up in the long run, and you can potentially lose an infinite amount of money if the share price continues to increase instead of going down as what you have forecasted. Right. So the second not so obvious risk is of course the regulatory risk. So governments, right, when all the stock markets are in downfall, free fall, they can come in and say, oh, I'm going to ban short selling in a particular sector or maybe in the whole market in just a simple snap, and cause a sudden spike in the stock prices. This will force the short seller to cover the short positions and incur huge losses. The last downside is the potential of margin calls. So before you can short a stock, brokers will require you to have a margin account where you must deposit at least a percentage of the position's value, ranging from maybe 10% to even 70%. So for example, if you want to short 100 shares of a stock trading at $90, okay, like Meta, with a 10% margin, you will only need to put up $900 as collateral. So we are effectively looking at a 10 times leverage here. In the event the stock price just goes up by 5%, it will be 5% times 10 times. It will be a 50% loss on your total position already. And when that happens, right, usually the broker will require you to deposit more cash or close out your position because you fail to meet the margin call. To sum up, okay, we have talked about 3 ways to do short selling. The usual traditional method, okay, you sell high and then buy back low. Buying put options and buying inverse ETFs. Of course, do remember to take note of the risk as well. We have come to the end of the video. So we hope that you have enjoyed this video. If you want more tips and advice on how to invest for the better, be sure to subscribe to my channel and hit the bell notification. Next up, you can also watch this dividend stocks video if you want to stay on the defensive. We'll see you next time.